are back, my son. Even the S&P is down 19.5, but all that means nothing when you've got this man, Chris Vecchio. And let me explain. Chris, how are you, my friend?
Gentlemen, I'm doing much better that I'm back with the Batman.
Did you avoid the flooding? Or did you survive? Did you have like an arc or something that you were able to get on?
Now you're making me feel insensitive. I didn't text him or anything. I asked him how he was.
I know, I haven't either, but I'm asking him now, so.
I didn't survive. This is, in fact, the specter of my spirit.
That's good. That's good. Okay.
Well, are you in a high rise?
No. I mean, we're north of the city.
Okay, I didn't know where you were.
Property's on a hill, so we avoided much of it. There was some flooding in front of my daughter's school, but nothing that rain boots and some conviction can get you through.
Yeah, my friends in Brooklyn were really they had some issues. I mean, we were right by the water in Sheepshead Bay area, so it was they had some issues.
It's crazy.
Yeah, it's crazy. Anyway, what's going on with you, my friend?
Oh, this is a market that feels like it's in a little bit of a liquidation mode. The dollar's ripping higher the last several weeks. Gold and silver are melting down. Basically, everything that's not nailed to the floor has been selling off steadily. If it's been bonds or stocks or maybe even a new regional banking crisis that's starting to come to the forefront. BRBS has been on my radar here the past few days. Blue Ridge Bank shares. They've been getting absolutely slaughtered the past several sessions. Stock's been basically cut in half over the past week. But I really want to talk about what's going on in terms of this extreme shift in bearish sentiment that we've seen occur in recent weeks and months. Because I myself am an eternal optimist. I'm looking for some tradable lows here in stocks to take a directionally long bet at some point moving forward. Volatility has expanded, so a combination of selling some puts plus maybe even buying some out-of-the-money calls through the end of the year looks like an appealing high convexity trade for me. And one such thing that pops to the forefront is what's happening with individual investors. The AAII Individual Investor Sentiment Survey wraps up every single Wednesday, is released Thursday mornings. And last week, I couldn't help but notice that there had been a spike in bearish sentiment. So a piece of research I shared with you, gentlemen, something that was subsequently published on the tastylive Traders blog, was about this 3-month shift because it's reaching the territory, not quite there just yet, but it's reaching the territory where you could say that we have become too bearish too quickly. In fact, over the past 3 months, the net bears has increased by 16.5%, which, to put this in simple terms, if there were 0% bears 3 months ago and now there are 16.5% bears, we'd say that it's gone up by 16.5%. So just using that as our framework, when we look back over time, over the past 3 years, just basically at the COVID era in this market, the average shift in bearish sentiment, 23.2%, has produced a return of 0.3% in the S&P 500 over 1 week, 4.1% in the S&P 500 over 1 month, and 9.5% over the following 3 months. Now, I'm using a technical filter to see if this downtrend actually breaks because the S&P 500 is sitting at the uptrend from the year-long, trend line. Last October, this past March, we find ourselves just hovering in that area right now. But since September 15th, we have not been able to clock a close above our 1 week moving average. So with those two things in tandem, right, this extreme shift in bearish sentiment, sitting at major trend line support, if we can finally get that break above the 5 EMA, I'm certainly going to be interested in looking at this volatility environment, looking to, dare I say, call a short-term low here in stocks and play for what has typically been a seasonally bullish month of October. October, November has been very strong for the past 5, 10, 15, 20 years. In fact, over the past decade, you've seen a 5.5% rally in your fourth quarter. And October is known as the bear killer for a reason, gentlemen. Since World War II, 7 of the 18 bear markets that we've experienced in the S&P 500 have ended in the month of October. So while things are gloomy, things are looking bad
11
right now.
Right?
Well, I'll tell you, I'm looking for a tradable low right now in this market. It hasn't come together yet, but it's certainly on my watch list as we prepare for this end of the year.
Well, I should say that the market's actually upticking a little bit, which is nice. Even the S&Ps are down 17, but to the flip side, volatility is still up 60 some odd cents, which is a little worrisome for the move for today on a very granular. I think you're talking a lot more a big picture here than I'm kind of going right now.
I like a little wall worry.
Yeah, I actually like that you mentioned. I didn't know about that regional bank that you mentioned just a moment ago. You see, you need those headlines. You need those reasons for why
That
we're
fear.
imploding. Like, you need it to be known.
Yeah.
Because once it's known, then you're past it, and it's it's kind of everybody then start to sell.
That's the
and that's when you can go-
capitulation. That's
the
like that.
capitulation.
You need that
Now, I
kind
don't know
of
if that small
headline.
banking, regional bank.
Yeah, but if you
it.
get a couple more of those or some weakness in like KRE or something like that, you get the markets in turmoil on CNBC. That's kind of the, like those are, when those start to flow and you get those kind of stories. You got Veneta with the $30 billion hedge fund liquidation at the
Yes.
end of the month or
Yes.
whatever.
Yes.
You're starting to kind of get those, which is nice to see. But I mean, the action in bonds and the market as a whole and volatility, I don't know. It doesn't seem like we're there just yet.
Well, something's got to give in this bond market. I mean, there's really two ways to look at how the market's interpreting what the Fed may or may not do in the path forward for inflation. If you look at ZB or UB over the past few weeks, you see an absolute slaughterhouse. And they're behaving like the Fed is going to continue raising rates, that inflation will remain a problem, that we are going higher for longer. But then you look to the rates markets and you look at the SR3Z4 contract, which is effectively how we can imply where the Fed funds rate will be at the end of next year. And that hasn't moved whatsoever. In fact, it's still pricing in basically a 4.6% Fed funds rate, which, why do we care about that? Because at the September Fed meeting, the Fed told us next year rates will not be 4.6% at the end of the year. They upgraded that forecast to 5.1%. But the rates market's not buying it at all. So someone's wrong in the room right now. Either the long end of the curve is wrong to suggest that, okay, this is the new reality. We are staying up here for a long time in terms of the Fed funds rate, or the rates market is, wrong in suggesting that the Fed is not going to follow through on its conviction to keep rates elevated for longer. So it's not something that I've traded before, but in the back of my mind, I'm beginning to think about what would a closing of that spread look like, right? Do either long end yields need to come down, or do we need to see the SR3 contract sell off more? That could be an interesting out of the box pairs trade here over the next several weeks and months, because quite frankly, in an environment like this, you have to be able to flip over every stone and look for those high convexity opportunities wherever we may find them.
Well, you looked at the Fed Watch tool earlier this morning, and you said it was a 25% for a 25 basis point in November.
We got 24%. December, it gets up to like almost 38% for a 25 basis point. And then there's another 6% for a 50 basis point.
Which is
hike,
small.
Which is small, but you're getting more into like that 40, 60, 55,
Right.
45 kind of,
I'm
no
keen
hike
on that
versus-
number, Chris, that you said on the Fed Watch tool last week, I believe, or the week prior, where it gets to 50% or more. 55% or more. They've always done what the Fed Watch tool has said they would do.
Yeah,
They would always
they
raise.
haven't gone against the grain.
They haven't gone against the grain. They haven't
Yeah.
gone with the 45%.
Yeah.
So I'm keen on that number and kind of discounting the rest of them.
That's exactly the key threshold. 55%, if you go back to 1996, anytime the market's priced in 55% in either direction, the Fed has followed through in that direction 100% of the time. So we're not there quite yet. But, one of the complicating factors is this government shutdown or lack thereof. And I say that because I think the market was actually looking forward to a government shutdown. We looked at the return profile for the S&P 500 when the government shut down. You go back to 1976. The average shutdown lasts 9.5 days. The average return for the S&P is 0.3% during a shutdown. The median return is also 0.3%. Markets moving higher during government shutdowns 57% of the time. And the context in which this would have happened would have been, well, the Fed is looking for the economy to slow down. You take government spending out of the equation just for a week or two, and it's going to shave a little bit off of GDP for the fourth quarter. Aggregate demand comes down, less government spending, deficits are inflationary. Well, this should help their case for not needing to raise rates again. But I guess the clown showdown in DC decided to get its act together, at least for the next 45 days, or should I say 42 now, because we did kick the can down the road into November. And so we're not going to see that slowing of government spending, at least in the very short term, which means that the economy will continue along its current path. And the Fed will still have to consider raising rates again at some point over the next few weeks. I don't think it's going to be November, though, if they do it again this year, right? They talk about being data dependent. We really only have two data releases between the September Fed meeting and the November Fed meeting, a CPI release and a non-farm payrolls report. Are one data point on each side of the jobs and inflation ledger enough for the Fed to say this is going to tip the scale for us? I don't think so. Instead, December really should be in the crosshairs. That's where we're going to get that new summary of economic projections. Whether or not we actually get there is another story, because there are signs that the economy has some cracks in it right now, that we could see a little bit more weakness here in the fourth quarter. And by the time we get to December, the Fed may say, you know what? We don't need to do more. We don't need to be the ones who engineer a hard slowdown in the economy at this point in time. We'll just let the whims of the market continue to carry us. And whether or not that's a good thing for bonds or stocks is another story, but I think a government shutdown actually would have been greeted with a little bit more optimism than what we've seen thus far play out in bonds and stocks here Monday and Tuesday.
So can we finally put government shutdown behind us for all eternity? Like it doesn't mean anything? Whether we always say we're not going to have one, doesn't matter. We're going to come to an agreement, and if it's not today, it'll be tomorrow or the next. I mean, you're telling me now that maybe it's good for the market. I mean, so does it really matter? I mean, should it be news? Is it newsworthy?
No.
Is it sponge-worthy?
It's not necessarily newsworthy, but I think one of the important pieces of the puzzle here, rating agencies are always a day late and a dollar short to whatever story we're talking about. But they have been more vocal recently about a deterioration in U.S. governance and how this could impact the credit rating. So there's a small segment of people in the macro world saying, well, look at this government shutdown. Look at the fact that you have a Florida man, Matt Gaetz, trying to oust Kevin McCarthy as speaker, which means you're going to have more discombobulation and disagreement in the House. It's going to be difficult to get the next continuing resolution passed, as it were. Further signs of U.S. government's deterioration. You need to apply a little bit more of an uncertainty premium in your bond market there, and that could be one of the reasons why we've seen bond yields, at least at the long end of the curve, continue to behave the way that they are. And so I don't think we're out of the woods here per se. Markets like to chase the next shiny object, and in absence of any other news flow, the government shutdown is a shiny object for the market to chase. So we get to play with that ball again in November, right before Thanksgiving, because why not? Why would we want to have a functional government that keeps us funded as opposed to just stringing along and finding pennies between the couch cushions every few months?
You mentioned, before I let you go, gold ever so quickly. Gold down $3.
Silver just reversed its. I mean, silver was down. It's now in the green. We're having a little bit of a rally here. I don't want to get rid of him. He's doing good for my positions here.
He's actually done good for the market too. Yeah, I mean the S&P down 9. I was to say, any play. What's your opinion on gold? You have anything there? I mean, I heard you on bonds.
Right now. Yeah, I was looking and waiting, right? There was this window in September where you looked at the way that Treasury yields are moving both in nominal and real terms, and they're pushing up to cycle highs, in the real yield case, multi-decade highs, and gold was just kind of hanging out. Gold volatility at a point there was actually lower than bond market volatility. That was a historic. We've never seen that before. And so I was looking for an opportunity to get long, figuring that if the gold market is holding up under these circumstances, well, then it's probably going to do really well when the winds, come to its back. Obviously, the best laid plans of mice and men often go awry. Thankfully, I didn't put a position on. I stuck with my oil trades instead. Gold's been flushed out here. I mean, I'll be looking at gold if we can get closer to those March swing lows. If you look at the GCZ3 contract, it's a little bit of a misnomer because you're looking at where that contract is traded, but the continuous shows us that the lows are closer to 1810 or so. If we get down into the 1810 range, given all the circumstances right now in the near-term horizon for gold, what's been influencing it, I think that's actually a pretty good long pickup opportunity. And think about that on a longer-term basis. But gold and silver, I got to eat crow on this. Anton has been eating crow with me too on Futures Power Hour. We thought that gold and silver were proving a lot more stable than they should have been, and this last week has made us look like absolute jerks. So thankfully, nothing was in there. My ego is hurt, but my portfolio thus far hasn't been dented.
This is what drives me crazy with when you're picking numbers. 1810, we're 1840. I mean,
right there.
2 weeks ago we were flirting with 2000 or 1950 and change. I mean, if you're waiting for 1810, 1844, it doesn't really make a difference to me. Might as well be in now, right?
Oh, it's $300 on my micro gold contract. So if I'm down there,
that is true.
I might be squeezed out.
That is true. All right, Chris. Any parting words, or can I let you go, my friend?
Futures Power Hours every Monday through Friday, 1 p.m. Eastern, 12 Central Time. And be sure to join us on Overtime. Dylan Radigan now comes on as a guest, 4:30 Eastern, 3:30 Central, every Monday through Thursday.
Tons of great feedback on the show.
Awesome. Good job out of you, man. We'll take a quick 90-second break and come back. We've got a market measure next. This is Tasty Live. Thank you, Chris.
damn, are we going to rally?